Good morning. Hello and welcome to our session on Bellevue Healthcare Trust, or BB Healthcare Trust it was called until recently. This is a high conviction, unconstrained, long only vehicle invested in a concentrated portfolio of healthcare companies that the managers believe will provide innovative solutions to what they see as a broken healthcare system that exists around the world. Before we hear from manager Paul Major, a bit of housekeeping. We have a presentation around 20 to 25 minutes with plenty of time for Q&A. So please do use the box at the bottom of the right-hand corner of your screen to submit questions, and I'll try and get through them all if I can. So without further ado, here is Paul.
Thank you very much. Good morning, everybody, and it's great to have the opportunity to present to you this morning. Hopefully we can try not to spend too much time focusing on geopolitical events, but I think it's probably worth at the end maybe touching on inflation and things like that. So I'm going to talk about how we think about healthcare and the opportunities that brings for investors. I'm sure some of you have heard some of this before, but we'll try and make it interesting and interactive nonetheless. So just a little bit of background. This strategy is managed by Bellevue Asset Management. We are a Swiss boutique investment house, very much focused on healthcare. Around 2/3 of our assets are in healthcare related strategies. We have about 18 different healthcare strategies spanning everything from private equity through to various public markets strategies. And within the healthcare investment firmament generally, and even within Bellevue, this strategy is a little bit unique in the sense that it marries a stock focused bottom up approach with a top down thematic overlay. And as William touched on at the beginning, that's very much predicated on the belief that the healthcare systems of the developed world are broken and they need to be reimagined to meet the demands that they face in the 21st century. So let's maybe start a little bit with the positive, which is that demand. So it's difficult, I think, probably to be optimistic about a lot of things at this moment in history, but we are unremittingly optimistic about the outlook for healthcare for the simple reason that this is a demographically driven demand story. There are ever more people in the world. Those people on average are richer than previous generations and are older. And if you think about human disease, the burden of human disease, as we illustrate on the bottom left-hand side of this slide, it falls overwhelmingly on the elderly. And the challenge there is that the over 65s in most developed countries, they're no longer technically economically productive. They're retired citizens, not necessarily contributing as much from a tax point of view, but they are consuming the overwhelming proportion of healthcare expenditure. Now, most of those people are burdened with chronic diseases because as you age, your body wears out and it starts to fail to perform at the appropriate level. And I can attest to this as a middle-aged man. I'm sure many of you can relate to things like high blood pressure, type 2 diabetes, osteoporosis, broad macro cardiovascular complications, and of course, unfortunately for most of us in the end, cancer. And the burden of chronic disease should not be underestimated. Just to put this in context, so a chronic disease can't be cured. This is something you have to live with forevermore. And 7 out of 10 pounds spent by the NHS here in the UK is actually toward the management of chronic diseases. So we face this overwhelmingly positive demand outlook for our services. It is not linked to the economy in any way, as I'm sure you know. Nobody willingly consumes healthcare. I'm sure we all do it because we have to, not because we want to. And the reality is we will all end up consuming it. So we can be positive for the demand outlook for as far as we want to look into the future, that there will be ever more need for healthcare products and the market will continue to grow. On top of that, we have what we call a scientific innovation premium, which is that we unpick the molecular basis of disease continually through medical progress, and that opens up new avenues to spend money on keeping people well and alleviating the burden of human suffering. So all of that is absolutely wonderful and great. And as you can see on the bottom left-hand side, and this is an important discussion at the moment, I think this is very much an inflation hedge sector because the demand is not linked to the economy at all. Healthcare expenditure will grow year on year because of those demographic demand drivers that we've talked about. The challenge is, though, because the population is aging, because we are finding ever more ways to spend money by unlocking new diseases, healthcare expenditure grows faster than the economy. And you can see that in the middle of this slide where we have US CPI as the line and we have healthcare expenditure inflation as the bars. You can see historically it's been materially above inflation. You can see the government's expectations for the future are that it will continue to be above inflation as well. And that is very much true for every country in the world. You'll know here in the UK, the political football that is NHS funding is continually discussed. Every government says we gave the NHS real terms increases in the budget. This is absolutely true. So the CAGR of the NHS budget is around 2.5% a year. But if you actually look at what the data shows you, it would need to be more like 3.5% a year just to ensure the service doesn't erode in terms of quality, standard and capacity, because there is this ever increasing demand. So what does that mean in practical terms? If you go back to 2007, the Tony Blair administration's last big increase in the budget of the NHS, if we'd have stuck with that 3% instead of the 2%, the NHS would be spending £20 billion a year more than it spends today. That is about 4 or 5p on the basic rate of tax, which of course is not politically acceptable. So these are the challenges we face. We need to think about reinventing healthcare because we cannot afford to let it grow in a way that the demand outlook would result in, because society is not willing, nor can it afford to pay those very, very high costs. Now, the positive side of all of this is if you actually look at healthcare as a business, what you'll find is it's not a very well organized one. So roughly 1 in 4 things that doctors do, so seeing patients in the GP surgery or in the hospital setting, afterwards are deemed to be not medically necessary. So there is an enormous wastage of resources. There's also an enormous wastage of financial resources, partly linked to that inappropriate treatment, but also generally partly linked to the way that healthcare works. And what that means is it's generally accepted around the developed world that between 25 and 30% of all the money that is spent on healthcare is to no medical benefit whatsoever. So this is a $10 trillion global industry growing at 4 or 5% a year. You think about that wastage and what could be done if it could be put to a positive use. It's pretty incredible, really. And then we talk about the human side of it. You know, we know there's a shortage of doctors. We know there's a shortage of nurses. We know that it's becoming harder and harder to attract people and retain people in this profession. Part of that is driven by the fact that if you went through the hardship of 7 years at medical school or 3 years at nursing school, so you could go out and help the world and make people well, the reality that you would spend around 1/3 of your time doing paperwork is probably quite a depressing thought. And that, unfortunately, is how things play out because of the inefficiencies of the system. So the whole thing is not the way it should be and not the way we want it to be. But the really interesting thing about this is it's also not the way it needs to be, because the tools, products and services that would enable you to think about healthcare in a completely different way, they exist today. And more importantly, in the context of this presentation, they are accessible as investment opportunities for you right now. And that, I think, creates a very, very exciting mix. So let's talk a little bit about what the future might look like moving forward. So let's start with understanding a little bit about where the money actually gets spent. So this is a pie chart for the US marketplace. You're probably very aware that most of the political discussion, certainly in the United States these days, about healthcare costs is always around drugs. And if you look at the companies that dominate benchmarks, you know, if you are invested in a healthcare ETF or whatever, it is your very, very large pharmaceutical companies, your Pfizer's, Novartis's, Johnson & Johnson, and so on. And most of the innovations that you'll be familiar with that have made investors money over the last 20 or so years have been in novel medicines, you know, pharmaceuticals and biotechnology, or they've been in other medical products. So you know, hips and knees and cataracts and all those interesting implantable things that people have put in their bodies. That's around 4% of the pie. Drugs are around 10% of the pie. So we've made our money investing in a small sliver of innovation, and we've barely touched the sides of actually thinking about healthcare as a holistic cost problem for society. And the opportunities around some of this stuff are profound and interesting. So in as much as you might think reducing the burden of paperwork on people, for example, is a not very interesting thing to invest in, when you think about the fact that trillions of dollars literally are being spent on doing that paperwork, the opportunity to sell people tools to enable them to reduce it actually looks like a very, very interesting investment opportunity. So the first thing I want you to recognize is that the future of healthcare relies on a very holistic approach to solving what is a cost problem for society, and through that we can make progress. So what does the future of healthcare look like? Well, on this slide, which some of you may have seen before, are just really 10 themes that we think are really, really important. So first and foremost, everything has to be done differently. We simply cannot carry on in this sort of Struthian mindset of pretending that all of this is going to be okay, because it's not. We can't afford to do what we're doing, and if we don't address the system is going to collapse. And if you think that's a rather depressing thought, then just look back at any newspaper from the last 10 years around the Christmas period, and you'll find all these continuous headlines about the NHS in crisis, because it simply doesn't have enough capacity to be able to meet demand when demand surges in the winter months. Many of the things that we're investing in are facilitated by or have been made possible through novel technologies. So we can analyze data and understand relationships between cause and effect in ways that weren't possible even 5 or 10 years ago, and those trends are accelerating. And that is enabling these changes in healthcare by being able to do things better, but also by being able to understand, why are we wasting money? Why are we doing certain things that don't work very, very well? We need to recognize a couple of really fundamental realities of the human condition. Firstly, there is inequality in healthcare, and some of it is economic, but a lot of it is unavoidable, and it's genetic. You are the product of your inherited genes, and everybody that's on this call has a different risk and susceptibility to certain diseases. There are lifestyle factors that come into that as well. But much of the information about what your future healthcare outlook looks like is contained within your genes. And if we understand and analyze that, we can do much better with preventative medicine and really stopping people getting very, very sick in the first place. Coming back to that thing about 1 in 4 appointments are not medically necessary. One of the things that I often say is, for the past 20 or 30 years, the front door of the NHS has been wedged open, and you've been able to walk through it whenever you feel like it, which isn't really right if you think about it. We need to triage people first, so ring the bell before you get let in. And then we need to follow people through the system, because you will be amazed if you look at the data, the amount of times people don't go to follow-up appointments. They don't receive the treatment that we know that they need. And sometimes these can be really serious things, like people being told they need to see an oncologist and being scared to go, for example, is a classical problem. There are approximately 15% less cancer patients receiving treatment in the United States right now than the demographic information would tell you was the case, based on pre-COVID 2019 being the jump-off point. Those people are people who have not been diagnosed because they haven't had routine appointments and all these sorts of things. So that's just an interesting example of what happens if you don't have follow-ups and you don't make sure people get the diagnoses and the treatment they need. If you've got cancer and you don't know it, or you've got cancer and not receiving treatment, the outcome is obviously going to be very problematic, because this is a disease that just gets worse and worse all the time. Related to that, we need to admit that people are fallible. I'm sure every single person on this call has obeyed every instruction ever given to them by a doctor. You've changed your diet, you've done the exercises, you've been to every physio appointment, you take whatever medicine you're obligated to take every single day without fail. Of course you don't. We're human beings, we're fallible. This is the reality. And it needs to be recognized that that's the case. And we need to give people tools to enable them to do better at being compliant with the things that will control the chronic medical conditions they have and they can't do anything about. Related to that is really people understanding and being empowered to manage their own healthcare. Type 2 diabetes is a classic example of an indolent preventative disease that if you enable people and understand and educate people about why they're slowly becoming sick, they can intervene and do something about it, and you can actually reverse the disease really through the first sort of 5 or 6 years of that being a problem. And if you don't talk to people in ways they understand and empower them to make the right decisions in an educated way that's pitched at the right level, then you get problems. If you want to think about a classic example of that, then just look at all of the issues around COVID vaccinations and the resistance and reluctance of certain people to take their vaccines, for example, for the simple reason that they didn't understand the risk benefit, and it wasn't conveyed to them very well, given the fact that these drugs didn't go through any kind of a normal approval process, for example. We need to understand that arriving in a hospital is failing. Hospitals are incredibly expensive places. It's probably cheaper to stay in a suite at the Dorchester than it is to spend any time at all in an NHS bed. And I would imagine that you'd all probably prefer to be in the Dorchester than in an NHS hospital. Where you'd all probably prefer to be, though, is at home. And much more treatment can be delivered in the home setting. Another big societal trend that we're investing in, we've monitored for a long time, but we've finally committed to investing in, is the transition away from people going into long-term care as they age. The baby boomer generation do not want to go in old folks' homes. They want to be independent for as long as possible. They want to receive medical care at home. They want to have more choices in how they're treated, and technology is enabling us to deliver those things finally. And that is going to be a mega trend in healthcare over the coming decades that's really been quite significantly accelerated by what's happened through the COVID pandemic. Connected care and the so-called Internet of Things. Every device, every medical device that's in a hospital these days is full of all sorts of Bluetooth and other bits of technology that enable them to be connected together, and that enables you to remotely manage what's happening to patients and monitor it in real time, which is a huge productivity advancement. If you think back to the classical NHS model, walking around a hospital at night doing your ward rounds to make sure that nobody's died in the middle of the night. It's probably a bit late to treat them if they have, or whether or not they need anything. I had the very unfortunate experience a few years ago of having a skiing accident and spending some time in a French hospital. Not something I would recommend. No offense to any French people on the call, but they used to wake me up in the night every 3 or 4 hours and ask me if I was okay. I can promise you, after a couple of days of being woken up every 3 or 4 hours in the night, you are definitely not okay. If you can move to remote monitoring, you can get rid of all those things and you can deploy your staff much more efficiently. Now, all of these things talk about a world that's extremely different to your perception of how healthcare works today. And what that means is that the value is in a bunch of innovations that are going to be brought by companies you probably never heard of, delivering things that you probably didn't think are very, very important. And what that therefore means is that the value of incumbency and the speed at which ideas are going to come to market because of this necessity to make the healthcare system economically viable. I'm sure you all saw the article by Sajid Javid, for example, in the FT a week or so ago, where he said, the trajectory of the NHS is not financially sustainable. That's absolutely true. So we're living in an age of what we call the democratization of innovation, which is that the best ideas are going to win because the world is desperate for them, and therefore they're going to be almost sort of fast-tracked through. And that's another thing that really informs how we invest. So moving on from this, we come to my favorite slide, which again, many of you may have seen before. This is a pictographical representation of the modern healthcare system. So hopefully we're all in that green box on the left-hand side. We're happy and well and getting on with our lives. But because of those inherited genetic characteristics that you can't do anything about currently, because of lifestyle choices you may have made, I'm sure none of you smoke and drink and all those sorts of things, but some people do. And because of sheer bad luck, you could have a skiing accident, for example, you will at a certain point of time have a problem and you will seek the help of a doctor. Now, let's assume this is obviously a hypothetical chart. So let's imagine you can actually get an appointment with your GP. They will diagnose you, probably by asking you, the person who has no medical qualifications, what you think's wrong with you. There may be some sending you away for tests and all these sorts of things, but eventually they will come up with a view as to what is wrong with you and what should be done about it. Now, most of the time, we're talking about chronic diseases which can't be cured. And therefore, what we're talking about is managing and alleviating symptoms. So, rather crassly put, the success for the doctor is you going away and not bothering the doctor anymore because your symptoms are no longer bothering you to the point that they're problematic. Now, there will be an expectation that you will follow some kind of treatment protocol. So you'll take a medicine, or you'll make lifestyle changes, or you'll have physiotherapy or an operation or whatever it might be. The outcome that you get from all of this is generally not as good as you would expect from a clinical trial because people are fallible and they don't do exactly what they're supposed to, as we discussed earlier. But again, because most of what we're dealing with is chronic diseases that can't be cured, you're effectively now in a loop, because at a certain point of time, because it's a chronic disease, it will worsen over time, and therefore your symptoms will come back, and the whole process of managing you will go again, layering medicine upon medicine, as I'm sure many of you are familiar with. Now, on this bullet point, on this slide, there are 21 bullet points. Each of those bullet points is a product, technology, or service that exists today that has been demonstrated to improve the quality of care or lower the cost of care, or in many cases do both, and often also enable caregivers to make more effective decisions around the welfare of patients. And all of them are featured in our portfolio. So in essence, that marrying of this top-down theme with this bottom-up portfolio, we're not really interested in what's in any benchmark. We have an unconstrained philosophy. What we are interested in is companies that provide operationally geared exposure to the bullet points on this slide, and we create a portfolio of those that we believe optimizes risk and reward as best we can. Now, what does that mean in practical terms? Well, what it probably means for most of you is you end up with a portfolio that's full of companies that in many cases you probably haven't heard of or aren't very familiar with. And what we've tried to do on this slide is illustrate some of the companies that are either in the portfolio currently or have been in the portfolio previously, and the bullet points that they touch within the portfolio. And as I say, most of these are probably not household names. You'll see some companies you'll be familiar with, but many of them are very, very specialized companies. And that's kind of the point of our whole philosophy. We are very agnostic to the benchmark. We are unconstrained. It's a very high active share product, very low correlation with the healthcare benchmark. But all of this is intended to deliver superior returns over time. In terms of the portfolio, we end up being very US focused for various reasons we can tackle in the Q&A if you wish. The US is and is likely to remain the primary center for healthcare innovation due to all sorts of capital market and regulatory reasons, and that's reflected in our portfolio. So this isn't an intentional thing, it's an emergent property of our approach. We're much more mid-cap focused because we're looking for that operational gearing. We don't really like very large conglomerate companies where you're diluting exposure to the things that we think are interesting. You end up with a very concentrated portfolio, so over half the fund is in the top 10 holdings. And as you can see, we're taking full advantage of that unconstrained approach. You can see on the right-hand side of this slide, there are a number of sectors of the healthcare market that represent a meaningful proportion of the benchmark that we're not invested in at all because they're either antithetical to our approach or we don't think they're attractive from a risk-reward point of view at this juncture. Often the issue is valuation. Now let's talk a little bit about healthcare as an investment opportunity more broadly. As you can see on this slide, with the exception of the technology sector, healthcare has been probably the best place to be invested for a very, very long period of time. And that reflects the demographic trends that we talked about, the fact that it's economically insensitive and therefore not impacted by recessions in the same way as consumer discretionary activities might be, and the fact that we have, rather like technology, continuous innovation going on around unlocking novel medical products. Now, this very long-term positive trend belies something very, very frustrating, but also interesting that's played out over the last 6 to 9 months, which we illustrate on the next slide. So, not surprisingly, for an innovative sector, if you think about where your returns are going to come from, they're probably not going to come from your GlaxoSmithKlines and your Novartises, because these are huge organizations with multi-billion-dollar top line. So even if they do invent something interesting and cool, and in Glaxo's case that doesn't happen, but let's think about pharma more broadly, those things aren't going to make a huge difference to the top line growth rate of the company, and therefore they're not going to make a huge difference to the earnings growth rate of the company. Conversely, when you have small innovative companies, they can grow extremely quickly, and therefore the market re-rates them significantly more. So what you can see on the right-hand side of this slide is really just an illustration of large cap versus sort of mid-cap healthcare. And what we're showing you here is that historically, mid-cap has always done better, which talks to the innovation point that I spoke about, and just the simple mathematical reality of growth. It's easier to grow fast when you're small. There are periods of history where you've seen the small stuff, potentially higher beta, more volatile, derate, but it always historically has recovered quite strongly to reassert this profound dynamic of small and mid-cap healthcare significantly outperforming until the middle of last year. And you can see on the left-hand side, this is magnified, the extent to which these sectors have dropped off since late 2021. And the magnitude of the sell-off that we've seen, we touched on this in one of our recent fact sheets, is pretty extraordinary. So just an example, if you look at the NASDAQ Biotech Index right now, it's trading at the same levels it was trading at pre-COVID. So in late 2019. So what the market is trying to tell you is there's been no economically valuable medical progress over that period of time. Now, I'm sure all of you will be aware of everything that happened throughout the pandemic and would agree that that feels like a broadly nonsensical statement. Moreover, if you look at this, the rate of this derating that's happened, and again, we can talk about mid-cap healthcare broadly, or we could talk about specific areas like biotechnology. The pace of this derating has been incredibly fast. So it's faster than we saw in the 2000 NASDAQ sell-off. It's faster than we saw around the 2008 financial crisis, where there was an understandable, albeit wrong, concern that small companies that were dependent on financing might struggle to get that financing in the kind of credit crunch era. It's even comparable in magnitude to what we saw in 1992, 93 around the election of Bill Clinton. So those of you that will remember, Bill Clinton won the US president election, somewhat surprisingly, having pinched the nomination from being not a front runner. And one of the things he committed to was effectively reorganizing the healthcare system. And he appointed his wife, Hillary Clinton, as a sort of healthcare czar. And she pledged that if he got into office, she would nationalize the US healthcare system within 100 days. Now, none of that happened, but you can imagine how the market reacted to the election of Bill Clinton with specific regard to the US healthcare sector, given the idea that the profits might almost vanish overnight. And the sector has derated faster in recent months than it did even back then. I appreciate there's a lot of weird stuff going on in the world right now, but I think we can probably all broadly agree that doesn't make a huge amount of sense. Let's not forget this is a classic defensive growth sector. It is inured from inflation. It is inured from rising input costs like the price of energy, like the price of raw materials, because it's a very high gross margin, value-added, service-oriented sector. So this is a very, very interesting time, in my opinion, to consider investing in healthcare, because it has been buffeted by macro concerns that I don't think are particularly relevant, and that's created some very, very significant valuation anomalies, which we personally are looking to take advantage of. Now, those things have had a very deleterious impact on our performance in the last 6 months, as you can see in the relative 1 year performance here, but over the longer period of time, we have continued to deliver robust returns. As the market has sold off, you can see in the early part of this year, we have significantly increased our gearing to deploy additional capital and try and take advantage of what we see as some very, very attractive valuations, particularly in highly innovative sectors like biotechnology and some areas of medical technology. So we've deployed a lot of additional capital. We've tried to do it in a balanced way and do it across our portfolio. Now, I've talked a lot about small mid-cap companies, so I think it's probably worth talking about the liquidity of our strategy, because I wouldn't want you to have the impression that what we're doing is not very, very liquid, because it is. So what we're trying to illustrate on this graph is, we have our open-ended fund and we have our trust. There's about £1.1 billion of deployed assets in those two strategies combined. What we're trying to illustrate here is how long it would take us to liquidate the portfolio whilst reducing market impact, and hopefully you can see at the bottom it is a pretty liquid portfolio. I think of hopefully more interest is the bar chart. So what we're trying to show you here is within the existing liquidity criteria that we have for the portfolio, how much incremental capital could we deploy? So for example, if we move from 1.1 billion of assets to 1.5 billion of assets, that incremental 350 million, we could deploy 98% of that into the existing portfolio without breaching our current liquidity criteria. So this is a very, very liquid strategy, and that's why we are very happy to see it grow through inflows, and why we have an active tap issuance program for the investment trust, because any additional capital that we receive, because it's able to go into the same investments, it doesn't have any kind of negative effect on our projected returns. And as you might have seen on the previous slide, we aim to deliver double-digit annualized returns, and we have a 15% internal IRR hurdle rate that we use for selecting our investments. Let's talk a little bit about dividends. So one of the other characteristics about our fund, which is perhaps a little bit unusual, is we pay a dividend out of capital. We pay 3.5% of trailing NAV. So in other words, whatever the NAV is at the end of the calendar year, we basically pay that out as a dividend in 2 equal installments in the next year. Now, why do we do that? Well, we recognize that for a lot of people, dividends are an important component. Sorry, healthcare is an important component of their dividend income, and for a lot of people, dividends are important. So we're effectively saying to you, don't invest directly in your GlaxoSmithKline and Smith & Nephew's, own this instead, and we're trying to give you that dividend back. And why do we pay a dividend out of capital? Well, the simple reason is that not only are we agnostic to dividends, but we would argue very strongly that dividends are a strong negative indicator of total return in the healthcare sector. And why is this? Well, this is a very, very innovative sector. Innovation requires you to be flexible around the allocation of capital. If you look at pharmaceuticals, which is the biggest single part of the healthcare industry, roughly around 50% if you add up all the pharma and biotech and generics and things like that, is pharmaceuticals. R&D doesn't scale, and R&D productivity relative to the cost of capital is pretty low. So if you're a large company and you need billions of dollars of incremental additional revenue year on year to keep yourself growing, you're going to struggle to develop that organically and in-house. You're going to have to look externally to acquire new ideas and to acquire companies to bolster your portfolio and keep growing. A bit like that scene in that film, The Wrong Trousers, where the bird, the penguin disguised as a chicken, is throwing the railway track in front of him. That's basically pharma R&D. You just have to create the illusion that you're not going to run out of track and the train is going to come off the rails, because the reality is that they're actually not very good at inventing stuff. So here's the problem with dividends. If you pay dividends out, money leaves the company, and that money is not available for you to use for external investments. So what you actually see is an interesting correlation, negative correlation, between dividends and being successful. And it's very, very notable that dividend payouts by US pharmaceutical companies, who dominate the global industry, as you know, are significantly lower than they are for their European peers. So we don't like dividends particularly. We think they're not a good thing to focus on when selecting investments in this sector. And we would rather give you certainty of dividend by creating it out of capital and then be agnostic to organic yield when we are building a portfolio. And that is how we think about dividends, and how we're able to give you, a progressive dividend policy where, over the 5+ years the trust has existed, you've seen a significant and growing dividend year on year. And there's no reason with the policy that we have that we can't expect that to continue moving forward. So in summary then, I think healthcare is one of the most obvious growth stories of our time. Few people can be as positive about the outlook for their sector as I can be about mine, because of the growing population, because of the aging population, because of the relentless progress that we're making in scientific discoveries, opening up new avenues to alleviate suffering and improve the human condition. However, we have to recognize the reality. The services that we have are not what we want them to be. They're not getting better, they're getting worse. And the cost of paying for these is creating a tremendous burden for society that is only going to compound itself over time as well. If we don't solve this problem, then our children are going to be significantly poorer than we are, and they're also going to have worse healthcare. So the system fundamentally has to change. We simply cannot carry on as we are today. But the good part about that is that the tools to enable that change are here. It's just really a question of adopting them and having the political will to be brave and admit that things aren't great and they need to be better. And if those tools are deployed, then we can see a future that looks much, much better. So we have created a product that gives you exposure to those things and does so in a way that hopefully delivers superior returns to owning direct investments in the healthcare sector. So that brings me to the end of my presentation. I'm very, very happy to take any questions. Thank you.
So if you do want to ask a question, just bottom right hand corner, tap in a simple question. I'll try and pose it for you. So first up, there have been a few related questions about what you're most enthusiastic about, but also what you've been doing in the portfolio over the last couple of months. This is obviously a pretty low turnover, long-term investment approach. But what are you most excited about currently in the portfolio, or have there been any areas that you've been adding to or increasing the weighting?
Sure, there've been a couple of things that have evolved over recent months. So, we've seen some very, very material declines in share prices across our portfolio over the last 3 or 4 months. That, as I say, don't make any real fundamental sense. So, as I hope you would expect of us, we've taken advantage of those opportunities to materially increase our total exposure to these companies. So across more than half the portfolio, the share count of what we own has increased very, very materially. We've tried to do that in a balanced way. So if you look at what's really got beaten up over the last 6 months, biotech stands out as a particularly battered sector, but we haven't just piled everything into biotechnology stocks, because obviously we want the portfolio characteristics to be preserved, and we want to try and manage risk and return as well as we can. But there's definitely been a pivot towards some of the more high technology stuff. So what we would call healthcare technology, which is real-time diagnostics, wearables, all those sorts of things. We've definitely increased our exposure there. We've increased our exposure to services and to healthcare IT, because valuations got very high in healthcare IT. Then they got caught up in the broad Nasdaq tech sell-off. So that's been an opportunity. Similarly, around some of the medical device names. I mean, a lot of what we've done. So the way we think about our portfolio is we have our core portfolio, and then we have companies that are various. I guess you think about it like a solar system. Rings going out of companies that are attractive or ready to be included into the portfolio, and we call those our watch list. And what we've seen is quite a few things come off the watch list and go into the portfolio because devaluation has given the opportunity for us to go in again around some sectors like tools. If you to look at the portfolio 3, 6, 9 months ago, we had a lot of tools. They got very expensive. We sold out of them. They've come back down. We've gone into them. So we've been buying a lot of stuff. Turnover has definitely been higher, and we've tried to do that in a balanced way. On the other side of the ledger, clearly, part of this has been funded by inflows. Part of this has been funded by drawing down on our banking facility. Part of it has been funded by exiting positions in some other things. So in the diversified therapeutics, which is more the big pharma end of things, where we have a little bit of exposure, and in managed care, which is US health insurers, they've done very, very well. They're absolutely the top end of defensive characteristics within healthcare, so they've held up very well through this period. So they've been a source of funds for us as we've moved down the market capitalization spread a little bit and got a little bit more into some more higher tech, higher innovation stuff, because the valuations have become incredibly attractive versus where they were 6, 9 months ago.
On that sort of topic, a question on the valuation of the portfolio compared to the broader market. I guess maybe American equities, I don't know, and the healthcare sector. How do you feel that? Where does it stand like that?
Sure. So that's a very complex question to answer. I'm not avoiding the question, but I just want to explain how I would think about it. So as I alluded to earlier, we have an unconstrained mandate. So that means if you look at the subsector exposures of our portfolio, and if we go back, you can see this writ large, here on slide 11. As you can see, the subsector weightings look very, very different. So for example, if we look at, healthcare IT, healthcare technology, what we call focused therapeutics, which is pretty much biotechnology, diagnostics, these are the highest rated areas within healthcare. So we don't really think about the valuation of our portfolio relative to healthcare or relative to the market. What we think about is the valuation of our aggregated holdings in these subsectors versus those particular subsectors. And the most important thing for us is to look at valuations from a speed of derating. So as I said, we use this 15% IRR hurdle. In many cases, we have companies that grow significantly faster than that. So what we're thinking about is, let's assume that the market is right today in its presumption that, biotechnology stocks that are profitable trade on 25 times forward earnings, for example, just as a random number. if we look at our portfolio 3, 5, 7 years from now, where are we relative to that? Because if these companies are still growing, then that multiple you should be able to roll forward, but we should be at a significant discount. So that's how we kind of think about valuation. So if we think about healthcare relative to the broader marketplace, valuations haven't changed very much, because we've obviously had a significant derating of the market. We've had a significant derating of healthcare. We have very predictable earnings in healthcare. So those deratings are all about share prices. They're very rarely about earnings. I think what has been the most interesting thing for me about why is healthcare not performed as well as you'd expect it to in a period of global uncertainty and all sorts of geopolitical challenges. You would expect people to flock to defensive assets, right? Why haven't these things done well? I think a lot of this is to do with the fact that COVID, we are coming out of the COVID recession, for want of a better word, at a pace that's really unprecedented in a historical context. We're seeing the economic output gap that always emerges from a recession actually be bridged, such that the economy is on the same trajectory or even a higher trajectory than it was on back in 2019. That's never happened in history before. So we're seeing all these huge positive estimates, revisions for cyclical parts of the economy. And what that means is healthcare looks really, really dull and relatively speaking, even weak, because this is the sector where analysts aren't revising their numbers up every time companies report, because the numbers are broadly right, because it's a long cycle, predictable kind of a sector. So valuation relative to history, I would say, is neither good nor bad when compared to the wider marketplace. But if you drill down below the surface, you look at some of these more premium, more growthy rated subsectors within healthcare, and particularly you adjust for size factor and look at small mid-cap companies, valuations are, approaching kind of 5-year lows, which I think is really, really exciting, for the simple reason that the growth outlook hasn't changed at all. There's no more reason to be concerned about the approvability of pharmaceutical devices or the availability of patients or any of those sorts of things. Nothing's changed from a regulatory perspective or a pricing perspective that would cause you to have different numbers in your model today than what you had 1 year ago or 2 years ago. So hopefully that kind of answers the question. So I'm not avoiding the general question, how does healthcare look relative to the market? I think it's a very, very difficult question to answer, because within healthcare as a whole, you have such a disparate group of companies doing different things and having very, very different market ratings, that it almost renders the sector level comparison as a moot point.
Thank you. I think we've got time for one last short question, which I suspect is probably short. Do you invest in pre-revenue or pre-profit businesses?
Pre-commercial, we call them. Yes, we do. And they probably make up about 20% of our book. I think with regard to those companies, the most pressing question that most people want to know is, how at risk are you from a funding standpoint? Because as investors will be aware, if you have companies that need refinancing and then market conditions look unfavorable for that refinancing, they can go into something of a share price death spiral, because everybody knows there's an offer coming and it's going to be at a discount to the current price. So they just drop and drop and drop. So we have 6 companies in our portfolio of 30 odd that will require financing within a reasonable period of time. So 2 within the next 2 years and 4 within the next 5 years. And all of those have what we call gating events between now and the end of those periods of time, where they will deliver clinical data or approvals for medical devices or new drugs or whatever it might be, that should profoundly alter the market's perception of the enterprise value. And therefore, we don't see those financing events as massive risks. But we are not scared of going pre-commercial, but we will not do early stage companies. So everything we do is based around available clinical or pharmaco or healthcare economic data, and we're very, very mindful of the reality that companies that are pre-commercial will need financing, and we build that into all of our models and scenarios and all those sorts of things. But it doesn't represent a material risk for our portfolio overall.
Thank you so much, Paul. Thank you, everyone who dialed in for logging in. It's been a very interesting chat. Our next session starts at 1 p.m. where we'll be hearing from ICG Enterprise Trust. So you've got a bit of time for lunch, or personally, I'll be using it to have my hair cut, which is long overdue. Thank you so much, and hopefully see you in an hour.
Thank you, everybody.